When you think about a portfolio, inflation hedge ends up being a very popular kind of term that people are thinking about or actually acting on. I believe that you own Bitcoin and gold. Correct me if I'm wrong there. And then how do you think about sizing inflation hedge type assets in a portfolio? Are there other assets that you're looking at from an inflation hedge perspective? And then also maybe any comments in terms of, it seems like the stock market has become an inflation hedge to some degree, and people are kind of piling in there as well. And so kind of how do you just think about what to do once you understand the inflation situation we're in?
Yeah, so at the current time, we're seeing a pretty good amount of inflation compared to the historical average over the past couple decades. And it looks like in certain areas that's rolling over, but it's still quite elevated, especially compared to bond yields. And so investors find themselves that the risk is that if you hold cash or bonds that are yielding 0%, 1%, 2%, while inflation is 4%, 5%, 6%, you're getting devalued. You're losing purchasing power, and so one of the ways that investors can deal with that is to buy treasury inflation protected securities or TIPS. And so some countries issue those, as a small part of their sovereign bond market. So my article focused on U.S. TIPS, and basically what they say is, we will we'll adjust the bond coupon that you're getting based on inflation levels, official CPI in the United States. And so that kind of takes away that risk of inflation. But my whole article focused on the fact that tips can be very useful as as an inflation defense, but they're not perfect. And so obviously, if you have that extra inflation protection built into your bond, there's no free lunch, and so that comes with some costs. And so the main cost is that the tips yields are lower than normal treasury bonds. And so in the United States currently, you're getting like a negative 1% yield on your tips. So you're getting you're basically going to earn inflation minus about 1%. So it's ironically you're guaranteed to underperform inflation by owning inflation protected securities, which sounds terrible, but it's one of those things where right now the 10-year treasury yield is it's under 1.5%, and the inflation expectations by the market are maybe 2.5%, while inflation is currently 5%, right? Because they're expecting that this is not going to stay at this level for a very long time, and that the average inflation over the course of the 10-year duration of this bond will be lower in the mid two range. Now, if that's the case, if the inflation expectations are true, then normal bonds and tips will have about the same return. They basically are optimized around kind of that break even point. However, if inflation ends up being higher than those inflation expectations, like if inflation is 3%, 4%, 5% averaging over the decade, then those tips, despite the fact that they will mildly underperform inflation, will still do better than normal treasury yields that are yielding 1.5%, while inflation's 3, 4, 5%. And so that's the kind of the trade-off that you get by owning tips, is that you're not guaranteed to keep up with inflation, but you have more protection if inflation runs notably higher than people expect. The other big risk of tips is that you're reliant on a government statistics for inflation, which include a specific basket of goods with hedonic adjustments, and people can debate endlessly about how accurate you know that measurement is. I generally, I've done work on this, and I think it at least mildly understates, quote unquote true inflation. But everybody has their own unique inflation basket, and so basically, with tips, you risk having your official inflation metric not keep up with real inflation, and then you also will mildly underperform even that official metric because of the negative yield. So I think anyone who has bonds in their portfolio at this time, which is not everyone, right? Because younger investors might choose to exclude bonds because of the poor yields and the inflation, and to focus on other assets, and take the higher volatility that comes with that, right? So obviously tips might not be ideal for them. But I think anyone who has bonds in a portfolio could benefit from having a percentage of those bonds be tips. And so I think this is an environment where tips are, I think, useful to have if you own bonds.
So given that tips aren't good assets to protect against inflation, at least for many different investors, what's the best way if you want to defend ourselves against inflation?
Generally commodities. And so it's hard to get sustained inflation while commodity prices stay low. I mean, that generally a history of inflation is a history of commodity price inflation. And commodities historically are a very poor performing asset class. If you look over, say, a century of data, commodities are one of the worst places to hold money over a long term because if you're holding the commodity outright, it doesn't compound, it just sits there. And if you're holding commodity companies, it generally tends to be lower quality businesses. There's some commodity companies that have done very well, especially in energy because they've been protected by a cartel for decades. But generally, it's not good to have a company who doesn't control the price of their own product, right? So they generally are not not the highest quality wide moat businesses that that might be appreciated. Uh, the caveat there is that during an inflationary decade, commodities generally trounce everything else. Like it's not even close. And so in the 70s is pretty much all you would want to own. In the 2000s, commodities and emerging markets, which had a lot of commodity exposure, were the way to go. They trounced everything else. And so generally, when you have these inflationary decades, you want to have some commodity exposure, and that it, ideally you want to mix it up a little bit so you're not too focused on one commodity. You want to pick the one commodity that maybe doesn't do very well. Oil and gas are the biggest commodities. I mean, that market is bigger than all other commodities combined. So, a lot of it comes down to what that's going to do over a given, you know, 3 to 5 year period. But overall, I think one of the best ways to have protection against inflation is to have commodities and commodity companies. And if someone wants to reduce the risk, they can use commodity trend following, which is basically saying, you're kind of acknowledging that it's not a great asset class to hold long term and that you generally want to restrict your exposure to them when they're in an upturn because the upturns can be pretty violently good, right? Just like explosive gains, but then the downside can be brutal in the opposite direction. So I think some sort of either commodity exposure or commodity related investments. Could be commodity trend following, could be commodities, could be commodity equities. They're generally the better way. There's also real estate if you can get it at appropriate prices, right? Which is harder these days than it was maybe a couple years ago. But obviously, certain zip codes, certain regions of the world of your country, wherever you might live, can be protection against inflation. And partly it's because with real estate, you can leverage it more than most other asset classes without it being silly, right? You can leverage it, with a mortgage, because it's a stable asset. And so what you're essentially doing is you're shorting currency. You're shorting the currency you borrowed that in. So if you have a reasonably priced house and you have a 30-year fixed rate mortgage on it at a rate that's at or below the inflation rate, you're shorting a depreciating asset and you're going long an appreciating asset. And so that's historically been a better way, at least better than stocks historically. And then when it comes to stocks, you generally want to focus on ones that can control their costs very well. And so, people sometimes assume stocks will perform better than bonds and inflation, and that's a mixed track record. So obviously, if you have something like hyperinflation, you'd rather own stocks than bonds because bonds will become worthless. Stocks will still be worth something when the dust settles because you still own productive assets. Um, but if you have moderate, like if you have double-digit inflation, like the United States had in the 70s, stocks can perform about as poorly as bonds can in that environment. It really depends on some other factors like, what's happening to their own costs, what's happening to their valuations, what's happening to treasury yields. Um, but generally, if you do equities other than commodity equities, you generally want to find companies that their revenue is variable, that they have decent pricing power, but then also that their costs are rather fixed or controlled. Maybe they have large depreciation write-offs, for example. Those sort of assets, which ironically tend to be some lower quality assets in good times, can actually do pretty well in those inflationary times.
Could you talk to us about how investors could build his or her own personalized global portfolio? What should we consider? How do we do it in practice?
So I start out with a big diverse mix, right? So I have uh, companies from my country, which is the United States. I have foreign companies, And because, over the very long term, equities are the big compounder of wealth. Generally, equities or real estate are the ways we compound wealth over decades. And then you can look around for certain counterbalances, right? So there might be environments where you want bonds in your portfolio, and then you can choose, what types of bonds are most attractive. Do you want them as a big deflation hedge, or do you want to have them as dry powder to rebalance into more equities? Um, and then if you're in a decade where there's a reasonable chance of inflation and it being a commodities decade, uh, one of the most powerful things is to have some sort of commodity exposure. Could be commodities themselves, could be commodities equities, could be commodity trend following, where you ensure that you're most exposed in the upside and limiting your downside because it's a more boom bust, lower quality area than other types of equities. And so overall, I think it's about having that starting from that like diverse starting point and then tilting into areas where you think there's more value. So it could be certain countries, it could be certain factors, it could be say commodities versus tech, for example, if you think it's being more inflationary, more kind of emerging market based, and then wherever someone has kind of expertise, right? So or that they follow markets closely. And so I incorporate, say, Bitcoin into a portfolio where obviously not everybody would. And the position size is what manages the risk there. And so, you know, when you add together equities, some bonds, some real estate, and then commodities and some digital assets, generally I think that's very attractive way to kind of just preserve and grow wealth over the long term, even though, of course, you're going to encounter periods of volatility. My overall model for the 2020s is kind of like that, where I don't think we're just going to have like this big giant runaway inflation, but I think we're going to have these periods where prices go up pretty rapidly and then maybe cool off for a time, but we don't deflate back down to where we were before. And so I think, basically by the end of the decade, people holding cash and bonds will have been able to buy fewer goods and services with those things than they could before. And of course, there'll be some disinflationary areas due to technology, software, music, maybe a clothes, a tire, but things you actually want, as Michael Saylor puts it, things that you actually key real estate, key companies, gold or Bitcoin, like things that are actually scarce, that aren't being just like made far more abundant due to technology. Those are the things that your bonds and cash are likely to buy a lot fewer of those things 5-10 years from now.